This episode is brought to you by Dashlane. Try Dashlane Premium free for 30 days at dashlane.com/infographics. And never forget another password and keep all your online accounts secure. Home sweet home. Whether you dream of owning a cabin in the woods, a bungalow on the beach, a condo in the historic downtown district, or a ranch-style house in suburbia, everyone wants somewhere nice to live. However, recently there's been a lot of talk in the media about how the average American worker, especially the younger generations, have been priced out of the US housing market and will never be able to afford a median-priced home. Is this true? We are by no means financial or real estate experts, but let's discuss some reasons why you may never be able to buy a house. A report released in September 2019 from a property data firm analyzed 498 counties across the US. They came to the conclusion that in 371 of those counties, or 74% of them, average wage earners could not afford to buy a median-priced home as of the third quarter of the year. The number of unaffordable counties has risen 6% from 6 months ago, when the previous report showed that 71% of housing markets were exorbitant for average workers. This report assumed that a potential homeowner is putting down 3% when they purchase the property, which is a fairly low down payment, much lower than the traditional 20% down payment wanted by most private lenders. Affordability was calculated by determining the amount of income needed to make monthly mortgage payments, property taxes, and insurance premiums. The final total was compared to the average weekly wage data from the Bureau of Labor Statistics. There were only 127 counties out of the 498 counties where a worker earning an average salary could afford to make the housing payments for a median-priced home in their area. Metro areas that were considered affordable by the analysis included Houston, Detroit, and Philadelphia. Furthermore, the report discusses how home prices are rising and will continue to rise for the foreseeable future. Granted, a report from a single company may not tell the entire story, but a variety of surveys across the board paint a similar picture. It's becoming difficult for the average American worker to afford to purchase a house, even when purchasing as a two-income family. The housing market is prohibitive for several different reasons. Firstly, in general around the country and especially in popular metro areas, there are a lack of homes for sale. Older generations are choosing to hang on to their current homes and age in place. When mortgage rates were lower, many homeowners took advantage and refinanced their loans. So currently, if they choose to move, they would end up paying more for the same mortgage on top of paying more for a move-up home. Even sellers who want to downsize are currently moving into a pricier market. While consumer confidence is currently high, many Americans feel anxious and uncertain about the future, so they're less likely to make a huge lifestyle change, such as selling a house and moving unless they have to. During the housing bust of the late 2000s, big commercial property companies began buying thousands of homes out of foreclosure. In many markets, those homes were not flipped and resold, but have been entered into the rental market. Both long-term and vacation rental demands have been strong for the past several years, creating solid investment opportunities, while low interest rates have made other investments less appealing to investors. Also in recent years, there's been technology created that facilitates buying homes online. As a result, investors have continued to pour more funds into purchasing properties. Even in 2018, big private equity firms, real estate speculators, and others that buy properties comprised more than 11% of U.S. home purchasers. Central to this discussion is the fact that investors purchased 1 in 5 homes in the bottom third of the price range of the national housing market in 2018. Those starter and fixer-upper smaller homes are exactly the type of property in first buyer price ranges. Furthermore, after the recession in the late 2000s, home building activity was slow to rebound. When new homes were built, builders mostly concentrated in the most expensive tier of the market for single-family homes. All of this adds up to mean that there are simply fewer houses on the market and prices can be driven up by buyers bidding on homes. Young families looking to purchase a starter home may be competing against other first-time buyers, as well as a company or house flippers. That means in hot markets, there are often bidding wars over homes. Sellers may have several buyers to pick from, and may even opt for a purchaser who can meet their specific demands, such as paying in cash instead of a traditional mortgage. Aside from the dearth of homes, especially starter homes for sale, achieving homeownership is hard because wages are not keeping pace with the appreciation in home cost. A study in the spring of 2019 looked at the salary needed to own a home in the 15 largest cities in the U.S. They used 5 metrics: home value, down payment, property tax rate, homeowner's insurance, and other monthly debt payments to model the salary needed to afford home payments. Per their study, San Francisco was the most expensive city to purchase property in, with the median home value of $1,104,100. Assuming that you could put down a 20% down payment and wouldn't want to take on a lot of debt, the salary to afford payments for such a house in San Francisco is an annual household income of $172,153. Per the U.S. Census Bureau, the U.S. median household income for 2018 was $61,937. The median income for California was slightly higher at $75,277. A study this past spring calculated the median income in San Francisco as approximately $96,265 for households and $74,841 for individuals. That's still over $70,000 shy of the needed annual income to afford a median home in San Francisco. Roughly 29.5% of U.S. households, or 37,665,335 households, made $100,000 or a six-figure income in 2018. Only the top 10% of U.S. households made $178,793 or more in 2018. Admittedly, the housing market in San Francisco is an extreme example. It's astronomical, fueled by limited property supply and a relatively small percentage of well-paid workers at tech companies. However, variations of the same scenario, where average worker wages fall significantly short of average home payments, is repeated in many areas through the rest of the U.S. The salary needed to afford housing payments is just the tip of the iceberg. The study looking at salary needed to own a home in the 15 largest cities in the U.S. assumed a high credit score, a 20% down payment, and what personal obligations a potential purchaser might have, such as student loan debt, were moderate. Often, it's hard for a first-time buyer to stockpile 20% of the house cost for a down payment. However, first-time purchasers have several ways of getting around having to pay this large lump sum. Some private lenders will accept a much lower down payment if the purchaser gets private mortgage insurance or PMI, which basically allows the lenders to recoup their losses if the purchaser defaults on their loan. However, PMI can be a significant cost, ranging as high as 1% of the buyer's total loan value per month. For example, a 1% PMI on a $200,000 mortgage would cost a buyer $200 per month, which can add up over the years. Mortgages from government-backed lenders such as an FHA loan don't charge PMI. However, they do still charge separate mortgage insurance. First-time purchasers can also opt for a low down payment mortgage through groups they belong to, such as VA loans, which are backed by the Department of Veterans Affairs, and USDA loans, which are backed by the Department of Agriculture. Both can offer 0% down payment options for borrowers who qualify. There are also FHA loans which are backed by the Federal Housing Administration and allow for down payments as low as 3.5%. However, in March of 2019, the FHA tightened its rules for insuring high-risk mortgages. After a surge of mortgages made to purchasers which lowered the average credit scores for borrowing purchasers to 670, the FHA became concerned that backing higher-risk loans could potentially lead to defaults, depleting cash reserves the federal agency uses to insure mortgages. As a result, the FHA reintroduced the manual underwriting requirements it removed in 2016, so that mortgage applicants with weaker credit scores and higher debt burdens will get closer scrutiny. While the rule will only affect between 40,000 to 50,000 borrowers a year, it's likely to heavily apply to first-time buyers. Some first-time buyers also take out conventional loans to meet 20% down payment costs. However, to do so, you must have good credit. So, assuming you have good credit, including a low credit-to-debt ratio, yes, that does include student loans, have an annual household income well over six figures, can come up with a 20% down payment for your desired home, and potentially outbid other purchasers, you can purchase a house in many locations in America. Why all the media attention or fuss over why average American workers can't purchase a home? Maybe the idea of owning a home doesn't appeal to you. You have plans to live overseas, live a minimalist, non-material lifestyle, etc. That's great. No one's saying that you must purchase a home to be considered an adult or a productive member of society. However, to many people, owning a home is a life goal, an important tenet of the American dream, and vital for long-term economic security. Whether home ownership is a personal goal for you or not, you should be aware of the factors affecting the housing market. This is part of a much larger conversation about income inequality, corporate greed, generational expectations, student loan debt, and even where America's future financial stability lies. No matter why you made the decision to never own a home, or more likely had the decision made for you, there is one smart life decision that you can definitely make for yourself that will make a big difference, and that's deciding to protect yourself online. And the best way to do that? With Dashlane. Dashlane keeps your personal information and digital accounts safe and secure with services like their dark web monitoring that immediately notifies you if it finds any of your personal information for sale in an online marketplace. The kind of thing that can really end up wrecking your credit and hurting your chances of buying a house even further. So don't be like millions of victims every day. Get Dashlane to keep your digital life secure and your odds of getting a house as high as possible. Head on over to www.dashlane.com/infographics for a free 30-day trial. And if you use the coupon code Infographics, you can get 10% off a premium subscription today. Do you have any plans to purchase a house? How are you able to make it work? Tell us your secrets in the comments. Now go watch our other video, The Most Expensive Things in the World. Thanks for watching, and as always, don't forget to like, share, and subscribe. See you next time.